How much is the potential of this drama likely to hurt the Indian economy and indeed confidence within it in terms of corporate governance and more?
Well, it's a fluid situation, and I don't claim to have all the insights into the specifics here. But in the factual territory, what we know and our published view from our banks analyst is that the exposure to the overall banking system, domestic and international, is about $23 to $24 billion as of March 22. Additionally, Indian banks have about one-third exposure out of this overall Adani's debt as of March 22. And public sector banks within that is about 25%. That gives you about $6 billion, whereas private banks are about 8%, about $2 billion. But on the overall capital expenditure story in India, that's sort of underpinned by other macro factors. One, that manufacturing companies in India have deleveraged. The banking system is well capitalized to take on a credit cycle. The government, as we have seen in the budget again, has been very, very focused on capital expenditure, raising the capital expenditure amount to 3.3% of GDP, which is more than a 15-year high in terms of capex, and it shows us a 37% growth on the revised estimate for fiscal year 23, budgeted for fiscal year 24.
I just want to know a bit more about Adani, though. You know, do you think it's going to change the way people look at, corporate India here as well? Because we've always had a corporate India having corporate governance, as you will, which gave it a premium on the market itself. And I know that you're an economist fundamentally here, Santanu. So, if they had plans to raise overseas, does that also become problematic because of what's going on?
We think that in terms of the funding of an investment cycle, if required, the banking system today is in a much better position compared to what you've seen in the last decade. So that is the main lever in terms of funding the investment cycle within India. And therefore, other entities should not be finding it difficult to raise debt or borrow from the banking system. As I said, the capital positions are the best in the last 15 to 20 years across large private sector banks as well as the public sector banks. So from the macro lens, we don't think this should become a systemic issue for the banking system to fund the credit cycle.
We're seeing the rout continuing, Adani rout erasing half of the group's value since that Hindenburg report. Santanu, India's growth is contingent on its infrastructure spending as well. We know that the Adani Group has committed about $50 billion over the next few years to build seaports, airports, a steel mill. Surely that may cause India some of its growth.
So if you look at the India growth cycle and the investment cycle in particular in India, we are doing about 30 to 32% investment to GDP already. The lever behind that, as I said a bit earlier, are the manufacturing sector overall having deleveraged. So the overall leverage in the manufacturing sector is low. Capacity utilizations are coming up. The government has been the leader in this cycle in terms of capital expenditure. It's not so much the private sector. So our view is that as the government sector leads the capital expenditure cycle and raises the capital expenditure from about 1.7% of GDP is what they were doing in the previous decade on average, to committing to 3.3% of GDP for fiscal year 24, and the banking system is able to fund the credit cycle, we should see the investment cycle going from the private sector as well. Now, there are considerations of monetary policy cycle tightening, et cetera, which might come into play, but the investment cycle is based on more fundamental macro factors than one particular group is what I want to point out.